My name is Ori Pounders and I'm a senior mortgage advisor on the Mortgage Broker channel. Let's talk about temporary interest rate buydowns and the monthly savings that it applies. I want to point out that when you're negotiating the price of your home, a price reduction of $10,000 is going to reduce your payment on average about $65 a month. However, if you utilize a temporary interest rate buydown, you can save a couple $100s a month depending on the loan amount and the interest rate. And the other important part of this is that the temporary rate buydown can either be paid for out of seller concessions, or it can even be added into your interest rate as what's called a loan level price adjustment. Okay, there are three different types of temporary buydowns. You have a 1-0 buydown, a 2-1 buydown, and a 3-2-1 buydown. So let's get into it. And for the sake of this example, we're going to use a loan amount of $500,000 at a note rate or a qualifying rate of 6%. First up, let's talk about the 1-0 buydown. In year one of your mortgage, it is going to be 1% lower than your qualifying rate. So if your qualifying rate is 6%, in year one, your interest rate effectively is going to be 5%. And then years 2 through 30, if you were to never refinance, your interest rate would be at your qualifying rate of 6%. And in this scenario, in year one, your monthly savings is going to be $313 for the first year. Next up, we're going to talk about the 2-1 buydown, where in year one, your effective interest rate would be 2% lower than your qualifying interest rate of 6%. So that would be 4% interest rate. And then in year two, your effective interest rate would be 5%, which is 1% lower than your qualifying rate. And then years 3 through 30, your effective interest rate would be that 6% or your qualifying rate. Now your savings in the first year, the first 12 months, is going to be $610 per month. The savings in year two goes back to $330 per month. And then years 3 through 30, if you were to never refinance, you would be at your note rate. And then finally, we'll talk about the 3-2-1 buydown, where in year one, your effective interest rate is 3% lower than your qualifying interest rate of 6%. So that's 3%. In year two, it'll be 4%. In year three, it'll be 5%. And then in years 4 through 30, if you were to never refinance, it would be back at your qualifying note rate. Now in the first year of the 3-2-1 buydown, your savings jumps up to $889 per month. In year two, it would be that $610 per month. And then in year three, it would be back at the $313 per month. As you can see by the example, this is an effective way to save money on your payment each month. It allows you to get into your home and start building equity on your home as well. Now, if you'd like to go over your specific scenario and see what you qualify for, go ahead and message me. I'd be happy to help you.